Generally speaking, when we look at the economic impact that we've talked about, so far what we have in place is $34 billion of tariffs from both sides, effective July 6th. When you look at that, compared to as a percent of imports or as a percent of GDP, really very de minimis right now. So less than 1% of imports, less than 1% of GDP impact. It's really that tail risk that I think is worrying investors, and that tail risk includes, potentially President Trump raising tariffs to $400 billion plus, China then retaliating potentially beyond tariffs, and I know we just talked about yuan devaluation as a potential tool. I think what's kind of creating some of the relief today is that the fact that the Chinese may not be using some of these tools beyond tariffs as retaliatory measures. And if you do look at the Chinese market, as you mentioned earlier, down 17–18% year to date, it really does show that they have not very much incentive to escalate this trade war. So for now, yes, we actually view that, especially in the technology type sectors, energy sectors, any kind of pullback could be a long-term potential buying opportunity.
Keith, do you agree? And if so, which sectors do you buy on concerns about trade?
Yeah, I think the general take for us is very similar, that the impact on growth relatively small. Potential for escalation makes this a bit more of a bumpy, risky ride, but our baseline remains that a trade war is unlikely. If you look at second-order impacts, I think that's what we're focused on. We've seen steel prices spike. We've seen soybean and food prices down 15%, and the renminbi move quite a bit. And then I think the other is knock-on effects of, is this priced in already? And we've seen the S&P PE derate over one turn from mid-March levels, and so our view is quite a lot is priced in amidst a still very solid earnings backdrop. We expect a beat in second quarter. And then in terms of sectors, we've seen industrials massively underperform relative performance versus the S&P back down to 5-year lows. So we could see a bounce back if tensions cool. And then on the flip side, you see retailers that are exposed should tariffs be implemented on consumer goods. That sector is massively outperformed, and so we could see a relative convergence in those two.
Keith, just as a hypothetical, and maybe it's fun to play the counterfactual, let's say that the administration did not decide this was the year to start getting aggressive on some of these trade fronts and renegotiate trade deals. What do you think the market narrative would be right now? I mean, has it really cost the market a lot, or is there a way to say, well, at least we're not talking about a market that's overheating and the Fed is behind the curve and inflation is flying out of control?
Yeah, I think if we go back and we say, what was the narrative in the first quarter, I would say it was slowing growth, rising rates. I would say the narrative started to shift in March, April, May, and even mid-June, which is growth is pretty good here in the U.S., rates stable, and our view is that a multiple should be closer to 18 times forward versus 16 times. I think to the point of trade, it's a healthy headwind to some exuberant sentiment where we don't have that risk of market getting ahead of itself and overheating. I would say the setup now is that higher rates and some of these trade risks are priced, higher growth is not.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.